Hello, and welcome back to Wisdom from Pages channel. Today, we have a special treat for all the investors out there. We're diving deep into one of the most influential books on value investing, The Intelligent Investor by the legendary Benjamin Graham. If you're new to investing, this book is like your financial compass. If you're an experienced investor, it's a timeless reminder of the fundamentals. Throughout this video, we'll uncover 15 invaluable lessons from the book that can help you become a more intelligent and more successful investor. But before we begin, make sure you hit that like button and subscribe to our channel for more valuable content on investing, personal finance, and wealth building. Let's jump right in. Lesson 1: Invest for the long term. Investing for the long term is a fundamental principle that Benjamin Graham emphasizes in his book, The Intelligent Investor. It's a reminder that the stock market can be a roller coaster ride filled with ups and downs in the short term. Daily, monthly, or even yearly fluctuations may lead investors to make impulsive decisions. However, Graham's wisdom encourages us to zoom out and look at the big picture. Over the long term, the stock market tends to exhibit an upward trajectory, reflecting the growth of the global economy. If you hold on to your investments for an extended period, you'll likely see substantial gains. Long-term investing aligns with the philosophy that time in the market is more crucial than timing the market. Attempting to predict short-term market movements often leads to frustration and anxiety. Instead, by adopting a patient approach, investors can benefit from the power of compounding, where your initial investments generate returns, and those returns, in turn, create more returns over time. This compounding effect can significantly increase the value of your portfolio. So, whether you're saving for retirement, a child's education, or any other long-term financial goal, remember that investing for the long term is a strategy that has stood the test of time and has the potential to help you build substantial wealth. Lesson 2: Invest in undervalued stocks. One of the core principles discussed in Benjamin Graham's The Intelligent Investor is the art of investing in undervalued stocks. Graham believed stocks were not just pieces of paper with market prices, but represented ownership in actual businesses. Therefore, he urged investors to approach the stock market with the mindset of a business owner rather than a speculator. One of the most effective ways to do this is by investing in undervalued stocks, those trading for less than their intrinsic worth. These hidden gems often go unnoticed by the broader market, allowing astute investors to purchase them at a discount. By doing so, you increase the margin of safety and set yourself up for potential long-term gains as the market recognizes the actual value of these stocks. Investing in undervalued stocks requires a keen eye for value, thorough research, and the patience to wait for the market to realize the stock's true potential. This approach contrasts with the speculative mentality of chasing hot trends or buying into stocks solely because they are currently popular. Instead, Graham's philosophy advocates for a disciplined approach that seeks to buy stocks when trading below their intrinsic value. This approach is akin to shopping during a sale, where you get more value for your money. Over time, as the market corrects itself and acknowledges the true worth of these stocks, investors who adhere to this principle will likely be rewarded with solid returns. Lesson 3: Diversify your portfolio. Don't put all your eggs in one basket. By spreading your investments across different asset classes, you reduce risk and enhance your chances of success. Diversifying your investment portfolio is a cornerstone principle of prudent investing, and Benjamin Graham underscores its importance in The Intelligent Investor. The adage, "Don't put all your eggs in one basket," encapsulates the essence of diversification. By spreading your investments across different asset classes, industries, and even geographic regions, you reduce the risk associated with any single investment. This means that if one asset in your portfolio encounters difficulties, the potential losses are cushioned by the performance of other assets that may be thriving. Diversification acts as a safety net, shielding your overall portfolio from extreme fluctuations and providing a more stable and predictable path toward your financial goals. Diversification is not only about asset allocation, but also about achieving a balance between risk and return. A diversified portfolio makes you less vulnerable to the extreme highs and lows that individual assets can experience. For instance, while stocks may offer higher returns over the long term, they can be subject to significant volatility. You create a more balanced and risk-aware portfolio by complementing your stock holdings with other assets like bonds, real estate, or even alternative investments. Additionally, diversification aligns with risk management, a crucial concept in investing. It ensures that no single investment has the potential to significantly impact your overall financial well-being, giving you the confidence to weather the storms and continue building wealth steadily. Lesson 4. Be patient. Rome wasn't built in a day, nor is your investment portfolio. Embrace the journey. Investing takes time and effort. Patience is not just a virtue, it's a powerful strategy for successful investing, as emphasized in Benjamin Graham's The Intelligent Investor. In today's fast-paced world, we often seek instant gratification, but investing is a long-term endeavor. The stock market may experience short-term fluctuations and occasional downturns, but history has shown that it tends to move upward over extended periods. Graham's wisdom reminds us that expecting to get rich quickly through investing is a misguided approach. Instead, embracing patience allows your investments to grow steadily and compound over time. It's like planting a tree. The longer you nurture it, the more bountiful the harvest. Moreover, patience is a countermeasure to one of the biggest pitfalls in investing: emotional decision-making. When investors react impulsively to short-term market events driven by fear or greed, they often make costly mistakes. However, a patient investor stays the course, adhering to a well-thought-out investment plan. They don't let the market noise distract them from their long-term goals. Patience enables you to confidently ride out market downturns, knowing that the market has historically recovered from even the most severe crises. It allows you to make decisions based on sound analysis and rationality rather than succumbing to emotional impulses. Patience in your investment journey can lead to more consistent and ultimately more successful outcomes. Lesson 5. Don't panic. Market fluctuations are normal. Keep your emotions in check and remember that the market always recovers in the long term. In investing, it's easy to fall prey to fear and panic, especially during turbulent times. However, one of the key lessons from The Intelligent Investor by Benjamin Graham is the importance of not succumbing to panic. The stock market is inherently volatile with its ups and downs, but history has shown that it tends to recover and grow over the long term. Panic selling during market downturns can lead to significant losses and even missed opportunities for recovery. Graham's wisdom encourages investors to keep a steady hand and remain rational in adversity. Remember that while market fluctuations can be unsettling, they are often temporary, and making decisions based on fear can undermine your long-term financial goals. Furthermore, avoiding panic is closely linked to maintaining a disciplined investment strategy. Adhering to a well-thought-out plan can mitigate the impact of emotional decisions triggered by market volatility. Successful investors understand that market fluctuations are part of the game and stay focused on their long-term objectives. When you resist the urge to panic, you allow your investments the time they need to recover and potentially thrive. Some of the best opportunities arise during market downturns as assets become undervalued. So remember, Benjamin Graham's sage advice: don't let fear dictate your investment decisions, and you'll be better positioned for financial success in the long run. Lesson 6. Don't try to time the market. No one can predict market movements consistently. Stay focused on your long-term goals. One of the key lessons from The Intelligent Investor by Benjamin Graham is the futility of attempting to time the market. Graham recognized that predicting short-term market movements is an exercise in futility. Countless unpredictable variables influence the stock market. Even the most seasoned investors and analysts need help to time the market accurately and consistently. Trying to time the market often leads to stress, anxiety, and costly mistakes. Investors who chase market highs and lows usually buy at the peak and sell at the bottom, eroding their wealth. Instead of attempting to time the market, Graham advocates for a patient, long-term approach. Investors can make informed decisions that stand the test of time by focusing on the intrinsic value of assets and the fundamentals of companies. Trying to predict when the market will rise or fall is akin to trying to forecast the weather months in advance. It's simply not a reliable strategy. According to Graham, successful investors remain steadfast in their commitment to their investment objectives, regardless of short-term market fluctuations. Avoiding the temptation to time the market can reduce stress, enhance your financial stability, and increase the likelihood of achieving your long-term financial goals. Lesson 7. Buy stocks because they're undervalued. It's not about following trends, it's about buying stocks with growth potential that are currently undervalued. Benjamin Graham's wisdom in The Intelligent Investor urges investors not to buy stocks solely because they expect them to increase in price. This principle challenges the common misconception that successful investing is about predicting which stocks will experience short-term price spikes. Graham argues that such speculative approaches are often rooted in market sentiment and can be highly unpredictable. Instead, he emphasizes the importance of investing in stocks based on their intrinsic value. In other words, you should purchase shares in companies you believe are undervalued, regardless of whether the market recognizes it. This approach shifts the focus from short-term price movements to long-term growth and value realization potential. By buying stocks based on their intrinsic value rather than short-term price predictions, you align your investments with a more rational and calculated strategy. This approach encourages investors to conduct thorough research to analyze a company's financial health, growth prospects, and competitive advantages. It also promotes focusing on the fundamentals rather than market hype or speculation. While it may require patience to see the market catch up to the intrinsic value of a stock, Graham's philosophy suggests that over time, undervalued stocks have the potential to yield more consistent and sustainable returns. In essence, this lesson reminds us that successful investing is about making sound, well-informed decisions rather than trying to predict short-term market movements, which can often lead to disappointment and financial losses. Lesson 8. Do your research. Knowledge is power. Before investing, understand the company and its industry thoroughly. One of the fundamental principles advocated by Benjamin Graham in The Intelligent Investor is the importance of thorough research before making any investment. Graham believed that investing in stocks is buying a share of a company, and as a shareholder, you should understand the business you're investing in. Doing your research means digging deep into the company's financials, industry, competitors, and growth prospects. It's about more than just reading headlines or following trends. It's about understanding the company's fundamentals comprehensively. By conducting due diligence and investing with knowledge, you reduce uncertainty and increase your ability to make informed decisions that align with your investment goals. The principle of research extends beyond the company itself. It also encompasses broader market and economic factors that can impact your investments. Keeping abreast of economic trends, geopolitical events, and global market conditions is essential for successful investing. Additionally, diversifying your sources of information and seeking out expert opinions can provide valuable insights. The critical takeaway from Graham's emphasis on research is that investing is not a passive endeavor. It requires ongoing education and a commitment to staying informed. By dedicating time to research, you equip yourself with the tools needed to navigate the complex world of investing and make decisions more likely to lead to financial success. Lesson 9. Don't be afraid to sell. If a stock no longer aligns with your investment strategy, consider selling to lock in profits or cut losses. In The Intelligent Investor by Benjamin Graham, selling is regarded as a crucial aspect of intelligent investing. Graham advises investors not to be afraid to sell a stock when it's no longer a good investment. This principle underscores the importance of regularly reviewing your portfolio and reassessing whether your holdings align with your investment goals and criteria. If a stock's price has significantly appreciated and is trading well above its intrinsic value, it may be a prudent time to sell and lock in your profits. On the other hand, if a stock's fundamentals deteriorate or it no longer fits your long-term strategy, selling can help you cut your losses and reallocate your capital to more promising opportunities. Making objective sell decisions is a hallmark of a disciplined and successful investor. Additionally, selling can be a strategic move to rebalance your portfolio. Over time, the performance of different assets within your portfolio may cause your allocation to drift from your desired targets. You can restore your portfolio to its intended balance by selling some assets and reinvesting in others. Graham's philosophy reminds us that holding onto investments out of sentimentality or a reluctance to realize losses can hinder financial progress. Successful investors maintain a dynamic approach, adapting their portfolios as market conditions and their own financial goals evolve. Therefore, while buying is essential in building your investment portfolio, pay attention to the importance of selling as a tool for optimizing your investments and protecting your wealth. Lesson 10. Invest in companies with a moat. Companies with competitive advantages are more likely to thrive in the long run.
Benjamin Graham's sage advice in The Intelligent Investor encourages investors to seek out companies with a competitive advantage or a moat. The concept of a moat refers to a sustainable and significant barrier that protects a company from competition in its industry. Companies with a moat often possess unique qualities that make it challenging for rivals to encroach on their market share or replicate their success. This could be through strong brand recognition, intellectual property, cost advantages, network effects, or regulatory advantages. Investing in companies with a moat, you position your portfolio to benefit from their resilience and long-term profitability. These companies tend to weather economic storms more effectively and are more likely to deliver consistent shareholder returns. Furthermore, a company with a moat often can maintain pricing power, which means it can charge premium prices for its products or services without fear of losing customers to competitors. This pricing power can lead to higher profit margins and sustained growth. It's essential to conduct thorough research to identify companies with these competitive advantages and understand the nature of their moats. While moat companies may sometimes appear to be more expensive investments up front, the long-term benefits of their stability and potential for growth make them an attractive choice for investors looking to build a resilient and profitable portfolio. Investing in companies with a moat aligns with Graham's principle of seeking safety and long-term value in your investments.
Lesson 11. Invest in companies with a good management team. Strong leadership is essential for a company's success. In The Intelligent Investor, Benjamin Graham underscores the significance of a strong and capable management team when considering company investments. A company's management team plays a pivotal role in shaping its future, making strategic decisions and managing operations. A skilled and ethical management team maximizes a company's profitability and ensures long-term growth and stability. Investors should assess a company's leadership by examining their track record, vision, and ability to adapt to changing market conditions. Companies led by competent management teams are more likely to navigate challenges effectively, capitalize on opportunities, and deliver value to shareholders over time. Investing in companies with good management is akin to entrusting your financial resources to capable stewards. A strong management team is responsible for allocating capital wisely, managing risks, and fostering a culture of innovation and excellence within the company. Investors should prioritize companies where management demonstrates transparency, accountability, and shareholder-friendly practices. While financial metrics are crucial, a company's human capital, the management team, is equally critical in assessing its investment potential. By focusing on companies with effective leadership, investors can increase their confidence that their investments are in the hands of individuals committed to achieving long-term success and creating value for shareholders. In essence, Graham's lesson reminds us that a company's fortunes are often closely tied to the caliber of its management, making it a vital consideration in any investment strategy. Lesson 12. Invest in profitable companies. Profits are a sign of financial health and potential for growth. In The Intelligent Investor by Benjamin Graham, the importance of investing in profitable companies is a central theme. Profitability is a key indicator of a company's financial health and sustainability. A profitable company generates excess income after covering its expenses, which can be used for various purposes, such as reinvestment in the business, paying dividends to shareholders, or reducing debt. Profitable companies are better equipped to weather economic downturns and disruptions as they have a cushion to absorb losses and continue operations. When you invest in profitable companies, you align your interests with those of a well-functioning business that is more likely to reward its shareholders over the long term. Profitability also speaks to a company's ability to grow and innovate. A company that consistently generates profits has the financial resources to invest in research and development, expand into new markets, and seize growth opportunities. It can also attract top talent and maintain competitive advantages in its industry. Profitable companies are often seen as more stable investments, as they have the potential to provide consistent returns, pay dividends, and achieve long-term growth. Therefore, as an investor following Graham's principles, prioritizing profitability in your stock selection can help you build a portfolio that stands the test of time and is more likely to meet your financial goals. Lesson 13. Invest in undervalued stocks. Yes, this one's important enough to mention again. Seek out those hidden gems. Benjamin Graham's philosophy in The Intelligent Investor underscores the importance of seeking out undervalued companies as a core investment strategy. An undervalued company is one whose stock is trading below its intrinsic or true value. Such stocks often go unnoticed or are temporarily out of favor with the broader market, creating an opportunity for astute investors. By investing in undervalued companies, you position yourself to potentially benefit from future price appreciation as the market recognizes their true worth. This approach is akin to finding a hidden gem or purchasing a quality item on sale. You're getting more value for your investment. Graham's lesson reminds us that the market's perception of value can differ from a company's intrinsic value, and investors who can identify this discrepancy may find attractive opportunities for long-term gains. Investing in undervalued companies requires thorough research and analysis. Investors must accurately assess a company's financials, earnings potential, competitive position, and industry dynamics to determine its intrinsic value. This approach contrasts with the speculative mentality of chasing after hot trends or buying into currently popular stocks, but overvalued. Focusing on undervalued stocks shifts your attention from short-term market sentiment to the fundamentals of the companies you invest in. Successful investors who follow Graham's approach often have the patience to hold on to their undervalued investments until the market corrects itself and recognizes the true value of these assets. Investing in undervalued companies aligns with the principle of seeking safety and value in your investments, providing a solid foundation for building long-term wealth. Lesson 14. Diversify your portfolio. Another reminder to keep your investments well-balanced. Diversify your portfolio is a fundamental principle emphasized by Benjamin Graham in his classic work, The Intelligent Investor. The concept is simple, yet powerful. Don't put all your eggs in one basket. Diversification involves spreading your investments across various asset classes, industries, and geographic regions. Doing so reduces the risk associated with any single investment or sector. The goal is to create a well-balanced portfolio and be less vulnerable to specific stocks or sectors' unpredictable ups and downs. This risk management strategy is critical in maintaining your investment's long-term stability and growth. While diversification doesn't eliminate risk, it helps mitigate the impact of market fluctuations and can lead to more consistent and less volatile returns over time. Furthermore, diversification aligns with the principle of risk-adjusted returns. Different asset classes, such as stocks, bonds, real estate, and commodities, have varying risk and return potential levels. A diversified portfolio combines these assets in a way that seeks to optimize returns while managing risk. For example, when stock prices rise, bonds provide stability, and bonds act as a buffer when stocks face a downturn. The key is to strike a balance that aligns with your risk tolerance and investment goals. By diversifying, you avoid the pitfalls of having all your investments tied to a single asset class, which can expose you to extreme volatility and potential losses. Benjamin Graham's lesson on diversification is a cornerstone for building a resilient and well-rounded investment portfolio that can weather various market conditions. Lesson 15: Be patient. As we wrap up these lessons, remember that successful investing is a marathon, not a sprint. Be patient is a fundamental principle throughout Benjamin Graham's teachings in The Intelligent Investor. It serves as a reminder that successful investing is not a get-rich-quick scheme, but a long-term journey. The stock market is known for its short-term volatility and unpredictability, fluctuating prices daily. However, history has shown that over extended periods, the market generally trends upward, reflecting the growth of the global economy. This means that patient investors who stay the course and hold their investments through market fluctuations are more likely to see significant gains in the long run. Graham's lesson encourages us to embrace the idea that wealth building through investing takes time, discipline, and a steadfast commitment to our financial goals. Moreover, being patient in investing is closely tied to avoiding emotional decision-making. When investors react impulsively to short-term market events driven by fear or greed, they often make costly mistakes. Panic selling during market downturns or chasing after hot trends can lead to financial losses. Patience lets you keep your emotions in check and maintain a rational, long-term perspective. By having the patience to endure market turbulence and sticking to a well-thought-out investment strategy, you can avoid the pitfalls of market timing and stay focused on your ultimate financial objectives. In summary, be patient is not just a piece of advice. It's a guiding principle that helps investors build wealth steadily and with greater confidence in the face of market uncertainties. Thank you for joining us on this insightful journey through the timeless lessons from The Intelligent Investor by Benjamin Graham. We've uncovered valuable principles for successful investing, from patience to diversification and so much more. If you found this video helpful and want to explore more wisdom from pages that can transform your life and finances, don't forget to give it a thumbs up and hit that subscribe button below. By subscribing, you'll stay updated on our latest videos and be part of our growing community of wisdom seekers. Your support means the world to us, and together we'll continue to unlock the secrets hidden within the pages of great books. Thanks for watching, and we look forward to sharing more wisdom with you on the Wisdom from Pages channel. Stay curious, stay wise, and until next time.